Good evening. The chart in front of us is that of the Nifty 50 and the time frame that is set up is on the hourly charts. And as we can see with the price action today, this is the day that is starting from today, which I will just mark with a vertical line and just color it blue or maybe purple. This is the day start today. We can see that there was a good gap up and the market continued to close pretty much near its day high. And the question asked is, could we have anticipated or forecasted this particular gap? And let me explain my perspective on this question. So first step is that all predictions that are made on the market through technical analysis is via extrapolation of an existing pattern. What do I mean by that? For example, you would note in the previous video when we were discussing the chart on Thursday, and because we knew that Friday was a holiday and we were preparing for a long weekend, I had, for some significant reason, made the point that if the preceding move is up and after this preceding up move, if the market decides to range for some time, that is, if the preceding move is upwards and if the market decides to range for some time, then generally the range is resolved in the direction of the preceding move. And this reference I have made several times in the past. It is not to say that if the preceding move is up and if the market ranges, then it cannot go down. The only point we are trying to make it is that it is a safer predictive bet to make that the market is likely to continue the direction of the preceding move before it got into a range. In other words, the traders need to have the skill to quickly identify when the market is actually trending and when the market is ranging. So to make the process simpler and independent from the subjective assessment that comes out of pure price action analysis, what we have done is we have decided to select certain indicators which will help us. If you recollect, in the previous videos itself, we had marked that the market, when we were planning, we had already marked that market is at that time, as would be the theme in the last few videos and is clearly apparent from this price action right here. At that time, we had mentioned that the market is ranging between 22,600 and 22,300. The phase under discussion is the one highlighted in this particular rectangle. And we were already prepared yesterday with the 4 cases that we discussed. If there is a strong gap up open, and we had clearly defined that a strong gap up open by definition is an open above 23,600, which is going to be our range high. If that is executed in the day, we simply have no action to take for the remainder of the day. And of the 4 plans that we discussed yesterday, the plan that actually got traded today was the first plan itself, a strong gap open above the high of the range. And since prior to this move, our assessment was of a range, and if our assessment is a range and the market gaps open, then any assessment that we have made will not be applicable for the day. So far in continuation, what we have learned is that by a simple ritualistic planning, we would be ready for the next day. We would know exactly when we are going to act, and equally important is we would know when we are not going to act. So let's plan based on the price action today. Let's plan for the next day's trade session. So our steps are as simple as discussed as always. We are simply going to select the ADX indicator, and here we will see that on the day closing the ADX indicator is at 30. We have already discussed that the conditions of trading an ADX, which I will mention here again very quickly, that if ADX is greater than 25, then the security is trending. And now if security is trending, then we are going to long the options. if the trend is upwards, which is obvious because we were prepared with the high of the range and we know that the market has taken out the high of the range. So if trend is up, then of course we are going to long the CE options. And only if the market is trending, then we will apply the moving averages. So historically, as has been in the theme in this video series that we have done, that since we have got a confirmation that the market is indeed trending, we were prepared a day in advance. We identified that the high of the range is 22,600. The market clearly created a new high. So now that it is trending, we are going to apply the moving average crossovers. And I'm going to change this default setting from 926, which is there in this site. I'm going to simply keep it to 2050. And once I have the moving average crossovers, they are giving me the values at which I have to plan my long trade. So once again, when we reach this stage of planning the trade, the trader has to decide if they are a single time frame trader or a multi-time frame trader. What is the difference between the two has also been addressed in the past, but to elaborate the point, the difference is that a single time frame trader will simply use the indicators as presented on just the hourly chart to determine their entry, which means that we have discussed before that if a security there is a bullish crossover is trading above it, then we will consider the moving averages as support, which is the 20 and the 50 period moving averages. And if a security is indeed trending up, we are going to buy the support. Since the support is at 20 and 50, this is where the two blue lines are going to mark our entry orders. And to identify the SL, we know that we are going to use an indicator called the average true range, which is currently at nearly 75 points. The average true range is nearly at 75 points. And we can see that the 50 period moving average is 22,525. So if I subtract 75 points from there, I am going to get 22,450. So I will just highlight this here. And I will mark this color as red. And now that I'm done with the moving averages, I'll remove them. And this is giving me the trade plan for a trader who's using a single time frame technique in order to make an entry and exit. If we were to apply this trade plan on options, then obviously the option plan would be to long 22,450 CE when spot at 22,565 and 22,425. Sorry, 525. This would be the plan. And obviously we will exit at 22,450 spot levels also, which is marked by this red line. So therefore, a single time frame trader has his assessment or her assessment very easily done. They can place these orders and back it up with the stop loss order in the system, and they are done. Their order is directly a function of their analysis on the single time frame. If they're slightly aggressive, they will apply this 2050 moving average, and if the market continues to trade above these levels, these averages will also start shifting above them. So an active single time frame trader will buy them at the test of these levels. That is, once again, as these so say for example, if the 50 period moving average were to move up to 575, then obviously since the ATR is approximately 75 points, our stop loss will also shift to 500. So everything will move with these two moving averages for the active single time frame trader. For the passive single time frame trader, the moving averages that was statically determined at the time of assessment will be the only entries. But for a multi-time frame trader, the multi-time frame trader, after having made the assessment, will only be able to come up with the SL value, which is the 450 CE at the time of assessment stage. And then when the day opens, when the next day opens, this trader will not be looking at the hourly chart at all, will not be using any of these indicators marked here, will simply have this trade plan and look at the entire day from a 15-minute time frame perspective. And in this, he or she will add an oscillator like the RSI, and such an oscillator would be set to a value of 4, because 60 minutes are being reduced to 15 minutes. And we can see that currently we want to buy a security on its pullback, and since the RSI is highly overbought, this is obviously not a pullback. So the multi time frame trader will now begin to wait for the RSI on the 15-minute chart to become highly oversold. It could happen straight out of the open, it could happen maybe a couple of hours into the trade session, but this is what an active multi time frame trader would do. And only once it becomes highly oversold on the 15-minute chart, then by applying the rule of 6 or price action on the final time frame, which is the 5-minute chart or the 3-minute chart, will the trader be able to take a trade. And it is at that time the dynamic values of the 20-50 moving averages and the thereabouts that will decide what is going to be the eventual SL for that particular trader and how many quantities they are going to take. So we will see how trading even on an intraday time frame and using such simple indicators can become very complicated on the execution front if we use a multi time frame technique. And it is because of these complications that I do not use them on extremely short time frames, because we only get 6 hours of trading in the day. That's the theoretical maximum, or 6.5. Whereas just by merely carrying forward the position, there is a possibility that I can get extended moves in my direction. And if I'm going to work so hard in order to determine an entry into a system, I might as well as be able to capture a good move as and when it actually happens. So once again, we have used this opportunity in the market to determine a plan for the next trade session. We have clearly understood of where we will act, when we will act, that the direction for the next trade session is obviously going to be long, at what point that bias will entirely drop. Once you have a long bias at the day of assessment, then the next day you can only trade on the long side. And we will accept any kind of whipsaws or any kind of challenges that come as a part of the process. But by keeping our process of assessment consistent and by doing it every day, I'm very confident that by planning itself, we will be able to beat 98% of all traders. And of course, being able to beat 98% of all traders means that you will be breaking even to having minor profits. Beyond a certain stage, application of more understanding and a little bit of luck and so many other factors come into play, where you could reach in the 99.5 percentile traders. And the reason for getting there is because there could literally be a 100x difference in your takeaway, on your annual takeaway, as compared to a 98 percentile trader. So it's obviously going to be a longish journey, but we will do our best. And one of the steps of completing that journey is by spending time analyzing the market and not being satisfied in your hunts for charts till you find a suitable chart for the next day's trade session. I hope that by using the Nifty 50 chart and the routine price action as it unfolds, we are gradually getting into a rhythm of how to prepare for the next day's trade session and how to plan our behavior in the market for the next day, which gradually we can use this understanding even on longer time frames and identify how we are going to plan our behavior in the market for the next week, for the next month, for the next quarter, and so on and so forth. So I wish you all the best. Thank you for your time.